This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we take a look at the EV space and Tesla, just how immune is the automaker to the latest China curbs on materials used for batteries.
Plus, we check in on the Magnificent Seven. Are those big tech stocks still moving in lockstep?
But first, we're going to talk about earnings. We're going to start with the U.S. Results have been stronger than we might have expected, but it's the outlook for the fourth quarter next year that gets a little murky. Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams joins us now. Gina, just staying in the U.S., if you had one word to describe earnings so far, what would it be?
Better than expected, but not as good as hoped.
Mediocre?
How about that?
That was like 9 words.
Yeah.
Mediocre?
Mediocre would work. It has been better than expected, but I think better than expected by the analyst consensus has just not been enough considering where prices were. And coming into the earnings season, we'd had a pretty magnificent rally from October's lows last year to date. Stocks were maybe a little ahead of their skis and anticipating a little bit more. So analysts were rational coming in, but the market at large maybe not as much. It just wasn't enough for the market.
So more of a top-line issue, margin issue, both?
It really generally has been very positive across the board. I'd say it's mostly a top-line issue. If you're going to argue about anything, it's the fact that revenue growth is still really paltry. Low single-digit revenue growth is just not enough to get terribly excited about. Earnings growth is also low single digits, but it's accelerating from negative, whereas revenue was much faster earlier this year and in 2022, and it's decelerating pretty quickly.
So I guess the question that I have is, why are we so surprised when things are murky? Like, I feel like, okay, third quarter's okay, mediocre, fine. That was my word. We can go with it. But like when we have sort of murky view going forward, like why are we getting so punished in the market?
Yeah. So I think a couple of things. Most of it is because of the rates landscape, really, is when yields are rising so quickly, it pressures valuations lower, and that leaves the onus of responsibility on earnings to drive any sense of optimism or direction. Clearly, as yields rise, the direction of valuations is going to be down. So the only way that you can get some upward momentum in stocks in that kind of environment is to have much, much better earnings growth emerging. And even though earnings have largely beaten analyst expectations for the third quarter, we're not seeing those expectations rise for 2024 or the forward 4 quarters. And so you're just not getting that pop that you would hope to get from earnings in an environment where yields are not a support. It doesn't mean that earnings aren't doing okay, that corporates aren't continuing to generally show some improvement quarter after quarter. For the last several consecutive quarters, we've seen some improvement, but that relative pace of improvement by comparison to the just vicious acceleration in yields has really dampened sentiment.
I think I know the answer to this question, but I will ask it anyway. How about earnings from small cap companies?
Okay, yeah. Small caps is interesting because small caps, as I'm sure you've noted, completely broke down at the end of last week. And small caps, frankly, are trading at incredible discounts relative to large caps. But small caps are also simultaneously struggling to beat expectations. So you've got really tough conditions in the small cap universe. And I think some of this is really related to the composition of small caps. Small caps had more healthcare companies where expectations were really elevated after the pandemic. And so small caps is suffering from that. Small caps also has a greater concentration of financials. They don't have the AI exposure to add some optimism on the other hand. So small caps are just kind of the center of greatest risk at that moment in the market, and it's showing up in earnings as well as prices.
See, listening to a handful of calls that I have, it feels to me that the recession is right around the corner. Yeah. Background is there in their guidance, and it's been there for 3 or 4 quarters because we didn't get the recession this year.
Yeah.
But now the narrative seems like, oh, well, then it has to happen next year. So as we give our guidance, that's our base case. You know, and I feel like that's kind of what I've heard a lot from some of the guidance.
Yeah. So this, I think, is really interesting because when we look at the entirety of the S&P 500, we actually find recession mentions and sentiment around recession peaked all the way back in 2022.
Okay.
Even and very consistently, quarter after quarter after quarter this year, we've seen recession mentions and sentiment toward recession get incrementally less and less negative. Now, we still haven't run the numbers for third quarter. I have a sneaking suspicion that rate of improvement might have stopped with third quarter, and we're going through the process of scrubbing the transcripts now and looking at our sentiment analysis on the transcripts. But I would doubt that it accelerated meaningfully yet. And most of that is because the companies that were in such distress last year are still showing incremental improvement, whereas the companies that were worried last year are still worried.
Okay.
Gina, so great. Super appreciate you. Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist.
Let's turn now to Europe, where we've seen a 5% decline in the Stock 600 since the start of the reporting season. To see where we are now, we bring in Bloomberg Intelligence Director of Research and Senior European Strategist, Tim Craighead. So, Tim, talk to us about what we've seen so far with your European earnings here. What's the outlook?
Yeah, so the earnings season, I think you can summarize it as saying it's one of the most disappointing earnings seasons we've had here in Europe since the pandemic had started.
So it's like a nice way of saying it, though, I think. Go ahead.
Well, on the surface, you'd think it's okay. It's like over half of the companies have beat and 30-odd% have missed. But that's the worst scorecard that we've had in a long time. Now, we don't play the game like the U.S. does, where you end up with 70 or 80% beats. But this is bad for us.
So what's driving it here?
Well, I think there are a couple of things. Number one, sales are missing the mark. In aggregate, with the companies that report, we're probably off 1 to 2% relative to what was expected in terms of growth. Margins, which we can get back to, have actually been reasonably resilient, but still there are some misses, and it's pulling down earnings. And don't forget, we're running at minus 10, 12% in terms of earnings growth. That's far worse than what you're seeing on your side of the pond. But we have big energy, we have big materials here. Both of those groups have seen massive contractions because of what's happened with energy prices on a lagging basis, having come down from big levels last year. And that's feeding through into our earnings. But even if you X those out, some of the other core areas, like industrials, are seeing earnings declines that we've not witnessed. And I think that's economics.
Talk to us about just the impact of, or maybe what we're hearing from the companies in Europe, what they're saying about the economy, because the economy, we just had a, darn near 5% GDP print here in the U.S., and obviously that's not the case in Europe.
Yeah, I mean, we certainly aren't running at the pace of the U.S., and I'm always a little bit loath to look at the GDP numbers because, famous last words, but they are a look back as opposed to a look forward. And the economic indicators, pretty much across the board, anywhere you want to look, are showing various contraction points of reference. What's going on here is I think companies are going back into the restructuring reorg mode. There was a lot of cost reductions that took place during the pandemic period, and then we had top lines take off, and there was a lot of operating leverage. What we're seeing with this earnings reporting period is an acceleration of those reorg restructuring announcements. We've had 17 companies report headcount cuts in the month of October, a total of 25,000 jobs across the Stock 600. That compares to the run rate per quarter so far this year, which was 19 companies and 20,000. So it's more in this month than what we'd seen in the prior quarters. And I think this is maybe just the start.
So any bright spots out there, Tim, so far, the companies that have reported?
Yep, Ozempic.
Yes, exactly.
And we're done here.
So, I tell you what, not to keep on the negative, one of those areas that's been really surprising, notwithstanding what you just said about Ozempic, a lot of the healthcare really disappointed. That's been anything but Energy stocks over here, which, not in the realm of energy transition, good old-fashioned energy exposure with oil and gas. And, BP may have missed a little bit today, but it was more for the trading purposes. They're certainly taking advantage of the current higher energy prices that seem to be higher for longer. And the likes of Shell and BP are playing well for the UK market, notwithstanding the last couple of days. So that has been one of those bright spots.
Yeah. It wasn't? The write-down on wind from BP. I'm just saying, talking about different projects. All right, Tim, thanks a lot. Tim Craighead, Bloomberg Intelligence Director of Research and Senior European Strategist.
Coming up on the program, we talk big tech stocks. Is the Magnificent Seven still trending up?
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
The Magnificent Seven, the seven big tech titans, recently went under the microscope at Bloomberg Intelligence. It's easy to group all of them together, but according to BI, they are not a monolith. For more on the major players in tech, we bring in Bloomberg Intelligence U.S. quantitative equity strategist Chris Kane. All right, Chris, we all know the Magnificent Seven, the big Apples, the Amazons, have powered this market so far, particularly in the first half of the year. We kind of throw them in there as just kind of big tech, but what did your work find?
Yeah, it's easy to kind of group these all together, but when you kind of look under the hood, there is a good bit of differences. So, as a quant, I really look at things from a factor lens. So we have our own multi-factor model here at BI. The four main factors are momentum, value, profitability, and low volatility, and we combine those for a multi-factor score. When you do that with the Magnificent Seven, you do see big differences, specifically on a multi-factor level. Things like Apple and Microsoft, and to a lesser extent Google, actually score pretty well. They're very strong profitability, pretty low volatility, et cetera. And then things like Tesla, NVIDIA, are much lower, and as well as Amazon.
Why? What accounts for that?
Yeah, sure. So let's go over the factors, right? So, the Magnificent Seven have their reputation of being very expensive, and they certainly are, but it does range. So I would call Amazon's value as middle-ish of the road. We have it as the 46th percentile in our value score. Higher the better. The rest of them are very expensive, basically in the 20th-ish percentile. And then NVIDIA and Tesla really take that to another level. They're extremely expensive. For example, NVIDIA is the 4th percentile of the index as far as valuation. So valuations range from moderate to very expensive. Profitability, so things like ROE, ROIC, are pretty much very strong across the board for all these stocks. Momentum is pretty strong across the board for all these stocks, as they've worked very well this year. But when you look at the low volatility factor, so low vol is better, you see a big difference as well. So companies like Apple, Microsoft are actually pretty low volatility, especially when you look at them within their sector. They're relatively low vol. And then again, things like Amazon and Tesla are much lower. They're extremely volatile stocks. So that's really kind of creating the separation, the volatility and the value.
Looking through your report, I saw a term I just love, GARP, growth at a reasonable price. I made a lot of coin with GARP investors back in the day. How does this Magnificent Seven, how do they screen on a GARP basis?
So we did, we plotted these things in two dimensions, right? So price to sales on the x-axis, the forward expected revenue growth using best estimates over the next year on the y-axis. Couple things stand out. So number one, NVIDIA is just like in a universe by itself. It's very, very expensive, and the analysts are expecting it to grow at an extreme rate, over 80% revenue growth over the next year. So that's kind of like out on an island. The other two that really stand out to me are Amazon in a good way and Google in a bad way. So Amazon looks pretty decent in the sense that, analysts are expecting about 11.7% top line growth over the next year, and it's only trading at 2.3 times sales. That's actually lower than the median price to sales ratio for the actual S&P 500 index. Google's the opposite. Google is trading at over 5 times sales, and analysts are actually expecting negative revenue growth over the next year. So that stands out towards the negative end.
Do investors really invest by these factors when it comes to the Magnificent Seven?
I think a lot of just individual investors that are buying these stocks aren't really looking at these factors.
I don't think they're looking at them for like, hey, this is low vol and I'm a quant. I'm going to go buy, Apple for low vol, for example.
Well, yeah. So we looked at how, where these stocks fall as far as the smart beta ETFs, which are factor-based ETFs. You do see things like Apple and Microsoft in a lot of low vol, low beta ETFs. You see a lot of these stocks, and as you would expect, momentum ETFs, growth ETFs. They're really in no value ETFs. So, certainly they do fall into those quantitative ETFs, that screen for these things. I do think the interest in the stocks, though, generally is not from a factor perspective. I think a lot of the retail investors and such, aren't really looking at it in that lens.
No matter how you screen them, again, just looking through your report, NVIDIA just jumps off the screen as you mentioned here. It's almost one of those things like you'd want to take this piece of research and go to the owners of NVIDIA and say, you need to get out of this thing or you need to short this thing. I mean, what's the feedback you've gotten here? Because NVIDIA, and you're not comparing NVIDIA to like a cement mixing company. These are Tesla, Microsoft, big growth companies.
Absolutely. Like I said, NVIDIA is like in a universe by itself. I mean, as far as the feedback I've gotten a lot of feedback that says, wow, this NVIDIA, valuation is extreme and it, is kind of off on an island. I will say shorting NVIDIA is not for the faint of heart, right? Because as we've seen, it's a very dangerous game. And if you want something positive with NVIDIA, at least its very, elevated valuations are paired with extreme growth, which is what you would want to see. I mean, I don't think you should buy any stocks that have 30 times sales, but at least if you do, they should be growing sales at an extreme rate. And at least what the analysts think, NVIDIA will be the stock.
But here's the sales call. Here's the sales. You just get at your Bloomberg terminal, HDS for NVIDIA. Call up everybody who owns NVIDIA. Hey, it's a great company. It's a great stock to own. Start writing some calls here.
Okay, as a way to play it rather than straight up equity. Yep.
Easy sales call to make.
And they're not too expensive? I mean,
probably, but
it's going to be cheaper than like trying to short the stock or buying it at this level.
Yeah. Plus, it's hard to get a long-term shareholder to say, let's short a little bit here.
Yeah. No, fair enough. So when it comes into ETFs, like what ETFs kind of have all these names? Is it the volatility? Is it the value? Is it the growth? Is it the momentum?
Sure. So growth is number one, as you would expect. So we looked at all 7 of these stocks. Where they fall in the smart beta ETFs. My colleague Athanasios Psarofagis helped me with this.
Nice pronunciation.
But yeah, so growth is the biggest one. They almost are all very prevalent in growth. The second one would be momentum. And as I said, the momentum of these things is strong across the board, and that's pretty logical. It's really carried the index this year. Low vol, too, not all of them. Obviously not like a Tesla or an NVIDIA, but things like Microsoft, Apple, even to a lesser extent, Google is actually in a lot of low vol ETFs. I think a lot of people would be very surprised by that. The ETFs that they are not in is value ETFs. You basically don't find them in any value ETFs. So that's really the factor that they don't really load on at all.
All right. I like this piece of research because I've got a sales call I can go out and work for the next several days. So that was valuable. What else are you guys and your team at the quantitative equity research? What else are you guys looking at these days?
We really try to focus on the factors. I do a lot of work. We have our MVP portfolio, which is our multi-factor top 50 of the Bloomberg 500. That report's going to come out soon. And I really monitor the factors, see how they're stacking up as far as their performance going forward, and that's really what we focus on.
In terms of other trends, like what are you looking at? Let's dividend yield, for example, like those kind of guys, breakout stocks, like how those trends are going.
So I did write, we did write a piece recently on shareholder yield, which we really, much prefer to dividend yield. So, dividend yield is, as you know, just the yield of the dividends, right? It's going to be very correlated to a value factor. But these days, companies have a lot of ways to return money to shareholders, right? They could give them dividends, they could buy back stock, they could retire some debt. Shareholder yield is a more holistic way, and it basically takes into account all of those, either direct or indirect money returned to shareholders. It's performed much better than dividend yield. And I think if you want to focus on a yield basis for stocks, I think that's probably the way to go.
All right. Our thanks to Bloomberg Intelligence, U.S. quantitative equity strategist, Chris Kane.
Coming up on the program, we're going to take a look at Tesla and how it's responding to new curbs on materials coming from China.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
China's putting new curbs on graphite exports, a material vital to EV batteries, and that could send costs higher for EV makers, including Tesla. Joining us now, Bloomberg Intelligence analyst for automobiles and industrials is Steve Mann. All right, Steve, how upset is Tesla going to be if they can't get their graphite? Walk me through the process.
I think that Tesla's the most immune to the back and forth that U.S. and China are having over trade. Now, this graphite ban is on the back of some of the tech sanctions that's put in place, and also back of the germanium and gallium sanctions that China has also put in place back in August. So the impact on Tesla is relatively less. The impact on consumers are also very small. But if you look at automakers, they're buying hundreds of millions of tons of this material, so the impact on their cost is meaningful.
All right, so just give us a whole sense here of, I think, electric batteries as a gating issue, if it is, to just kind of EV production, EV adoption going forward. Just what I keep hearing is the batteries are kind of the key thing here.
It is. It's about 15 up to 30% of the cost of an electric vehicle.
That's
so it is a question of what is the cost of acquisition for consumer. But Chinese have been building the supply chain since the early 2010, early 2012. So they've been at it for a long time, and they've built a very deep and wide supply chain. So they're able to manage costs very well. Their manufacturing process have been very efficient, built up to be very efficient. So they've been able to do this very well. And I think where Tesla comes in is, they have a plant in Shanghai. They've been working with companies like CATL. They're starting to work with BYD. So they're leveraging that low-cost production base, low material costs base out of China to really drive their EV sales.
So that's a Tesla-specific story. And as you mentioned, we've been worried about the rare earth ban, et cetera, from China. So there's been ample time to help out their supply lines. What about for other EV makers?
That's a good question. I think what these material ban or sanction is going to do is one thing that China's trying to do is trying to get the other automakers to source Chinese batteries. Because if you're working with CATL, if you're working with BYD, obviously they're not going to be sanctioned. The materials are not going to be sanctioned. So those companies still going to be enjoying the lower material cost. So I think the other thing that is interesting is the Inflation Reduction Act. I think U.S. is still probably years behind in terms of building up the supply chain to bring EV battery prices down. But the IRA is put in place to really to attract the material suppliers, the battery manufacturers to build their bases in the U.S. and hopefully down the road it can lower EV prices and drive demand for battery cars here in the U.S.
So, Steve, give us a sense of just the EV market in general in China. What's the demand picture look like? What's the adoption picture look like? It just feels like they are much more advanced.
Oh, yeah, it's night and day. It's night and day. And if if you look at total vehicles, EV sales in China, it's about 25% of total passenger car sales versus single digits, right, in the U.S. And I have to say, I think GM really started the EV trend in China. Their joint venture in China, probably 2-3 years ago, developed these micro EVs. They're less than $10,000, and they really sold a lot of them and really changed the mindset of especially the younger consumers to adopt EVs. So since these micro EVs that GM built a few years ago came into the market, you started to see that trend go up from single digit to 25% of total passenger vehicle sales.
So do you expect that the Chinese market to become like the iPhone market, for example, that there's sort of a nationalistic tendency, down with the iPhone, let's get into the locally made, cheaper phone? Do you think it's going to be the same for EVs? And I'm just wondering, where does that leave Tesla?
I do. And Tesla's a little bit different. They have a niche. I think if you were to look at Tesla, I would put them in the bracket of Apple iPhones. If you look at the iPhone industry, so they're in a niche of its own. But I think China really can't make a lot of money selling gasoline car because they don't own the technology. I mean, it's been around for a long time, right? And then if you look at hybrid, there's a lot of people talking about hybrid as the bridge between internal combustion engine or gasoline cars to battery EVs, and it's true, but China doesn't own the technology. The Japanese does. So for China to make a mark in the auto industry is really to push the battery EV and be ahead of the game.
All right, well, really appreciate it, Steve. Great insight, really interesting stuff. Bloomberg Intelligence automobiles and industrials analyst Steve Mann.
From EVs to ETFs, a recent fee cut by State Street to make its S&P 500 ETF the cheapest in Europe is one sign of how U.S. issuers are growing more aggressive in the region. For more on the ETF space, we bring in Bloomberg Intelligence ETF analyst Athanasios Psarofagis. Athanasios, thanks so much for joining us here. So tell us what State Street is doing here.
Sure. So they run the big S&P 500 ETF here as well. And what I found this very interesting is when we're constantly talking about the rise of passive or ETFs or even cost compression, it's very much a U.S. story. Hasn't really taken hold in the rest of the world. So why I found this is really interesting, they now offer the cheapest U.S. exposure in Europe. But what I found probably the most interesting from that is that the ones that are leading the cost compression in Europe are not the European firms. They're the U.S. firms. And I think that's pretty interesting because a lot of times investors like to go to their local issuers, right? U.S. sort of gravitates towards the U.S. firms, Europe towards the Europeans, Canadians towards the Canadians, et cetera. But I think it's kind of interesting that the cost migration is being led by the U.S. firms. I think eventually this might push some of the European ones to start to compress their fees a little bit more. But it was definitely a really big move for the European industry.
I mean, this kind of sounds like what the U.S. is good at,
Yes,
competition
exactly.
and price cutting. Do people really invest based on the fees? Because I have to be totally honest. If you threw a bunch of ETFs at me, I don't know if I would really look at the fees. How much of that is truly a factor versus, say, what's in it?
That's a really great point. And I would say in the U.S., we are very cost obsessed. But also that set the whole floor to come down. Europe is a little bit different in that distribution still is not quite what it is here, meaning in Europe, advisors still get kickbacks for recommending clients into certain funds. And this is basically what the mutual fund industry here was, in the 90s. So really, it's just a lot of times what your advisor is going to recommend. The reason they don't recommend ETFs is because they don't get compensated on that. But the rules are starting to change in Europe very slowly. A couple countries have adopted a model that's very similar to the U.S. And in those countries like the United Kingdom and in Germany, they're much more cost obsessed. Right, because the advisor is not getting the kickback anymore. What they want to save money for the client, so what they're doing is, well, I need to bring down the cost of the raw materials. Where's the lowest raw materials? It's in ETFs. I think eventually, as those walls start to come down, other markets will become more cost sensitive, more similar to what's happening in the U.S.
ESG investing has kind of been maybe peaked here in the U.S., but I know it's still really a big area of growth for European investing. Talk to us about the ESG space within the ETF sector.
Sure. So it's definitely a bigger part because of some of the regulatory changes. So, for example, a lot of investors can only buy certain ESG funds, or they've also been ahead in assigning ESG ratings to different funds and ETFs. Now, the SEC has been looking at something similar, but I think Europe is definitely always been ahead of this. So that's definitely one area where ESG is going to still be a pretty big chunk of the market. And really, most of the new products that are being brought out do have some sort of ESG screen incorporated into them. So that's almost just the baseline. Like, no product is really being brought into the market without some sort of ESG consideration.
Even now, even with the backlash?
There is no backlash in Europe. It's bigger, stronger than ever.
But kind of in terms of, say, like BP Shell walking stuff back, Rishi Sunak walking some stuff back. Yeah, I know. That's true. It's not just the E. Fair enough.
And I think there's been these cases where these, like Volkswagen or whatnot, it is. But in order to, here the U.S., I think of it much more as like a meritocracy. Like, an issuer will try its product. If the market doesn't like it, it'll just devour it and send it back. In Europe now, to do this, you'll have to unwind a lot of regulation, which is much harder to do. I think certain products might not make it, but the whole trend is moving towards that. So that's just a much bigger wave to stop.
All right, Athanasios, how about, we look at here in the U.S., it's just been extraordinary, the growth of the ETF business. We've even seen, mutual funds convert into ETFs. Do you feel like the European adoption to ETFs is far behind the U.S.? And if so, is that maybe narrowing that gap?
It is. I think one is definitely an awareness issue, meaning passive investing is about half of all the market here. If you take mutual funds and ETFs, it's only about 20% in Europe. So I think one is just there's an education gap on how passive works, its performance rates over active over time. But I think the second one, which I sort of mentioned earlier, was the distribution channels. And once that so if you look at passive ownership by countries, it's very different. So, for example, I mentioned the UK, they're much more like the US. It's probably closer to 40 or 50 there. But other countries that still have that distribution model would be much, much lower. It's not that I think they would be open to passive. I just think that the distribution channels sort of keep that at bay. But I think once that comes down, I think we'll see a huge acceleration in passive investing.
In terms of the issuers, is this all Vanguard and iShares, basically? Or are there other players?
There are, and you'll be surprised. Vanguard is actually, they're very small in Europe. They don't have the name recognition. So why I sort of started exploring this premise is most of the European firms have very strong market share in Europe. So like UBS, which doesn't have a business here, is very big in Europe, Deutsche Bank, et cetera. So I think that if they sort of adopted what some of the U.S. firms are doing and followed, for example, State Street with their fee cuts, they could do well because they have that captive audience. And I think just local investors want to stay with their local firm. But iShares is definitely a big one, but it's pretty shocking that Vanguard doesn't quite have the stronghold there that they do in this market.
So who are the big players in Europe?
Sure. So iShares for sure. And what's interesting about that, they actually have European roots because that acquisition came from They actually bought the Barclays business, so they sort of were always ingrained in Europe. Then number 2 will be Amundi, which is the big issuer from France. Deutsche Bank, number 3, right? And even, for example, like Amundi doesn't even have a U.S. business. So you have to get to number 6 even for Vanguard to pop up. So it's definitely more of the European firms and iShares that have the stronger market share in Europe.
Do you think that as though U.S. firms push into it and really compete on fees, that we're going to have to see consolidation?
For sure. And this actually happened even last year. There was Amundi and Lixor, which were one of the two biggest asset managers in Europe. They consolidated, and they're one. Now UBS and Credit Suisse, sometimes, that would have been not a necessity, but you're definitely seeing consolidation. I think Vanguard is growing, not to say that they're not, but I think as they grow, that'll definitely put a lot more pressure on some of the European asset managers to consolidate.
All right. Thank you so much, Bloomberg Intelligence analyst Athanasios Psarofagis.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.